Decoding Credit Risk in the Bond Universe, a comprehensive guide for investors. Introduction. In the intricate world of fixed income investments, evaluating credit risk is paramount for investors seeking to balance return potential with the preservation of capital. Bonds, as debt instruments, expose investors to the creditworthiness of the issuer, and understanding how to assess this credit risk is crucial for making informed investment decisions. This article unravels the complexities surrounding the evaluation of credit risk in bonds, offering investors a comprehensive guide to navigate the nuances of the fixed income landscape. Understanding credit risk. Credit risk, also known as default risk, is the possibility that the issuer of a bond may fail to meet its contractual obligation to make interest payments or return the principal amount at maturity. This risk stems from factors such as the financial health of the issuer, economic conditions, and changes in the issuer's industry. Investors must delve into various facets of credit risk to gauge the likelihood of a bond defaulting and the potential impact on their investment. Credit ratings as a starting point. One of the primary tools investors utilize to evaluate credit risk is credit ratings assigned by reputable credit rating agencies. Agencies such as Moody's, Standard & Poor's, S&P, and Fitch assess the creditworthiness of bond issuers. Assigning grades ranging from high quality, e.g., AAA or AAA, to lower quality or speculative, e.g., BB or BA. These ratings provide a quick snapshot of an issuer's credit risk, enabling investors to gauge the relative safety of a bond. However, investors should recognize the limitations of credit ratings, as they are backward-looking and may not capture rapidly changing economic conditions or issuer-specific challenges. Scrutinizing the rationale behind a credit rating and monitoring any changes or outlook revisions can provide a more nuanced understanding of credit risk. Diversification across issuers and industries. Diversification is a time-tested strategy for managing risk, and it holds particular significance in the realm of bonds. Spreading investments across bonds from different issuers and industries can mitigate the impact of a potential default from a single issuer. A well-diversified bond portfolio may include bonds from various sectors, geographic regions, and credit qualities, offering investors a more resilient defense against credit risk. For instance, an investor holding bonds exclusively from one industry may face heightened risk if that industry encounters economic headwinds. Conversely, a diversified portfolio spanning multiple sectors can provide a buffer, as the fortunes of individual issuers are less likely to correlate closely. Analyzing financial ratios and metrics. To delve deeper into the creditworthiness of a bond issuer, investors often turn to financial ratios and metrics. Key indicators include the issuer's debt-to-equity ratio, interest coverage ratio, and cash flow metrics. The lower debt-to-equity ratio signifies a more conservative capital structure, while a healthy interest coverage ratio suggests the issuer can comfortably meet its interest obligations. Analyzing cash flow metrics provides insights into the issuer's ability to generate sufficient cash to service its debt. Consider a scenario where Company A and Company B both have bonds with the same credit rating. By scrutinizing their financial ratios, investors can uncover nuances that may impact credit risk. If Company A has a higher debt-to-equity ratio and a lower interest coverage ratio compared to Company B, it may signal a higher susceptibility to financial distress, elevating the credit risk associated with its bonds. Macroeconomic analysis. The economic environment can significantly influence credit risk, making macroeconomic analysis an integral component of evaluating bonds. Economic indicators such as GDP growth, unemployment rates, and inflation can impact the ability of issuers to meet their debt obligations. Investors should assess whether an issuer's financial health aligns with broader economic trends and whether potential headwinds or tailwinds may affect credit risk. For instance, during an economic downturn, companies in cyclical industries may face increased challenges, potentially elevating credit risk. Conversely, companies in defensive sectors may demonstrate more resilience. By aligning their bond investments with a macroeconomic outlook, investors can position their portfolios to weather changing economic conditions. Yield spread analysis. Yield spread, the difference between the yield on a bond and the yield on a benchmark treasury security of similar maturity, serves as an indicator of credit risk. A widening yield spread suggests increasing credit concerns, as investors demand a higher yield to compensate for the perceived risk. Conversely, a narrowing spread may signal improving credit conditions. Consider two corporate bonds with similar maturities, one with a yield of 4% and another with a yield of 6%. If both bonds are considered relatively equal in terms of credit risk, the yield spread analysis would indicate a potential concern with the second bond, as investors are demanding a higher yield for assuming what is perceived as higher credit risk. Monitoring credit watch and outlook. Credit rating agencies often place issuers on credit watch or assign outlooks to indicate potential changes in credit ratings. Investors should closely monitor these indicators, as they offer timely insights into evolving credit conditions. A bond issuer with a negative outlook may face headwinds that could lead to a downgrade in the future, impacting the value of its bonds. For instance, if a company's industry is undergoing significant disruptions, a credit rating agency may assign a negative outlook, signaling potential challenges ahead. Investors can use this information to reassess their exposure to bonds issued by companies facing heightened credit risk. Conclusion. In the intricate tapestry of fixed income investing, evaluating credit risk is an indispensable skill for investors seeking to preserve capital and generate consistent returns. By combining credit ratings, diversification, financial analysis, macroeconomic insights, yield spread analysis, and monitoring credit watch indicators, investors can construct a robust framework for assessing the credit risk associated with bonds. Navigating the dynamic landscape of credit risk requires a judicious blend of quantitative analysis and qualitative judgment. It is an ongoing process that demands vigilance, adaptability, and a deep understanding of the interconnected factors influencing the creditworthiness of bond issuers. Armed with this comprehensive guide, investors can embark on their fixed income journey with confidence, poised to make informed decisions that align with their risk tolerance and investment objectives.